Good afternoon. Hello. Woo! Oh, this is awesome. I thought I'd have to be lifting energy after lunch, but it seems like everybody's got a lot of energy. So it's been a great day so far. We've heard from some amazing founders and entrepreneurs about the challenges that they've overcome, not only in starting a tech business, but also starting a financial business. And there are additional issues and complexities that you have to deal with when you're dealing with a financial services business. And as part of that, the FinTech Sandbox, who is very happy to be working with the MIT FinTech Club, what we try to do is remove the friction in terms of getting access to data for startups. So what we do is we make data available for free, and working with some of the large data providers in the financial institution space and capital markets to test their products and to advance product development and innovation in this space. I don't know if everyone's quite aware, probably a lot of people in the startup area are aware, but you can spend up to 40 to 50% of your burn rate on getting access to market data, which is more than you spend for your developers who are building your product. So this is a serious issue that we're trying to help to address. And then the FinTech Sandbox is also very happy to be part of this ecosystem with the MIT FinTech Club. I think we're fostering a real area of collaboration as we move forward, and I can't wait to see where it goes from here. So with that, I would like to introduce Eric, the amazing CEO of Addepar. Eric spearheaded Addepar's mission to solve the financial sector's intractable data and scale challenges. Before joining Addepar, he spent nearly 7 years at Palantir Technologies creating tools that enable organizations to make sense of large, disparate data sets. As one of Palantir's first 20 employees, he had also shaped its core technology while developing the finance business, which now represents more than half of the company's revenue base. With that, I'd like to introduce Eric.
Great. Thank you, Jen. And thank you for the MIT crew for putting on this FinTech Symposium. I was just saying to someone at lunchtime how thrilled I am that you got this many people excited about FinTech now. I've been really focused on this space since I got my first internship at Lehman Brothers back in 2003. I don't know if, for those of you who know what Lehman Brothers was. But, really what I wanted to focus on today is just talk broadly about the world of investment management. How important of a space this is, and frankly, how neglected it's been from a technology standpoint for a really long time, and the consequences that that has had. And then we'll really focus in on what Adapar is looking to do about it. So investment management. When I talk about investment management, I mean $120 trillion of assets globally that are invested. That is absolutely an amazing amount of capital. And these portfolios, of course, they're complex, they're nuanced, they're ever-changing. They're held in a variety of different ways. So some of these portfolios are owned by families and individuals. Some of these portfolios are invested on behalf of pensions, sovereign wealth funds, endowments, foundations. They're held in corporate treasuries. And so this $120 trillion, it has certain characteristics in common, especially as you're dealing with large, more complex portfolios. And so it begs the question, what's the standard technology platform that people are using to manage these complex investment portfolios? Oftentimes, it's many systems that were built before the internet was really a thing. It's millions of spreadsheets, and it's people serving as middleware, right? This is crazy. So for those, how many technical people do we have in the room? Would you like a technical system to be described as slow, non-deterministic, error-prone, unauditable? Probably not, right? And so this is something where it's just, the consequences that this has on the financial system, I think, are insane. It creates an extraordinary amount of risk. And this was really a problem that I first got exposed to back in 2003 when I was at Lehman. Just anecdotally, as day one into my internship, I was sitting on a trading desk. And maybe hour two, the guy sitting next to me put his keyboard straight through his monitor. I was kind of baffled what was going on. Turns out he made $1 billion trade in the wrong direction, clicked the wrong button, and hey, that's what happened. But what was more remarkable to me is he had a new monitor on his desk up and running within 5 minutes. So from an operational standpoint, the bank was just well equipped to deal with, putting more. So totally insane, right? There are all sorts of ways that this industry has just layered on Band-Aids on top of Band-Aids for decades. And this is a huge problem. So what's the most pervasive fintech of all? Any guesses?
Excel.
Of course. Excel turns 30 in September of this year. This is crazy that this is the most pervasive tech. So why? Why is this the case? Who cares? These are a lot of the questions that I've been getting over the last decade or so, and it's really exciting for me, for so many people in this audience, to be excited about fintech. So why this seems easy, this is actually a hard problem. Why, who cares? We'll talk about that in a minute. And a lot of folks who I talk to who haven't worked in industry before, I get this last question. No way. Seriously? Is this really a problem for such a massive industry? Why is it that we have such antiquated tech? So who remembers the 2008 financial crisis? It's a pretty big deal, right? This is really what turned this problem into an urgent and critical problem to solve. And as I noted, the solution is very hard, but it's tractable. So from my standpoint, it's been frustrating, to kind of observe this industry that's made out of people, process, and tech, continue to iterate on the people and process side while the tech has been 20, 30 years old. That's just, it's not actually going to get you there. So what we've done really, first at Palantir and now at Adapar, where we're focusing much more deeply on the investment management space specifically, is just really envision what does a platform look like for global finance? And what can we learn from a lot of the innovations we've seen in the past decade? What are the things that Apple's brought to bear that are super unique? And same with Google and Amazon and Facebook. And at Palantir, where I spend a lot of time. And how do we apply this very specifically to the world of finance and to the world of investments to actually make the financial system functional, or much more functional? And it really starts by, I think, focusing the entire ecosystem on serving investors. Who owns the portfolio? You need to first put that person in the position where they understand what's in the portfolio at any given time. It sounds very basic, and that really doesn't exist at scale today. So that's really the problem that Addepar is focused in on, is how do we get it right for the owners and the investors in these large complex portfolios first, and then how do we take that to kind of rethink other really fundamental parts of financial services, whether it's the way that investment products get distributed, or the other services that are ancillary that get basically brought into the market for investors, how marketplaces work, how new apps and so forth take shape. So today, Addepar is delivering a product that 100 plus clients are using. Those clients have an aggregate a little bit more than $300 billion of assets at this point. So the product is working. But the important thing is that the platform that we're building that product on top of is really unifying this data across these portfolios into internally consistent data models that cover the full span of asset classes across custodial banks and have multi-currency support and deal with the details down to the transaction and tax lot level across these portfolios. That problem is really, really hard. Who has, just by show of hands, who has an appreciation for the nuances of that particular problem? Okay, so maybe I'd say, 15%? And so these foundational problems are, I think, that this is what the disproportionate amount of the 130 people we have at Adapar are focused on solving. If you want to really sum up what we do is we make complex investment portfolios easy to understand. Sounds pretty basic, sounds kind of boring. The first I heard Joe who started Adapar after starting Palantir, was describing Adapar to me. And honestly, the very first conversation I had with him was just like, okay, that's doing performance reporting for wealth managers, yawn, but really rethinking these problems as such a foundational problem for the world of finance. That's what's gotten us to get these 130 people who are unbelievably talented and who really have folded into our culture of innovation, who just fundamentally want to rethink a lot of things that have existed just by virtue of inertia for decades. And so our team builds solutions that scale. The thing that we're doing that's unique, I think, in this world is that in that people, process, tech triumvirate, we're really focused on the tech first. How can you take the tech, radically rethink it, be really ambitious, where you cover the entire data challenge? You're not just kind of providing insight into the equity part of a portfolio, or you're not just a point solution for dealing with hedge funds or private equity or what have you. You're not just a visualization layer. You have to do a whole bunch of things in a really well integrated way to make this really work. And if it doesn't work for really 100% of the portfolio, it's not good enough, because then you have to fall back to Excel, and then you still don't have full visibility into what's happening inside your portfolio. And so here are just a cobbling of problems that we're solving and that we have solved. It really starts with aggregating all the data. This is the hard part. Some of the regulatory changes that came out of '08 meant that investors own the data about their portfolio. So for each of our clients, insofar as they have accounts at custodial banks, they sign letters of authorization releasing that data to Addepar on their behalf. So then we get the connectivity going with custodial banks. Once we have that data flowing, we marry it together with market data, and then that's what allows us to give our clients a full view of their portfolio across custodial banks. There we can marry it together with alternative investments. So many of our clients are invested in hedge funds and private equity funds and venture. Some have toll roads and commercial real estate and things like that. Others may have card collections and stuff like that, and they want to understand that in the context of a full balance sheet. But really just being able to represent everything that's in a portfolio in a unified way, in a way that's internally consistent, is the starting point, and that's when you can start doing cool stuff on top. Now, taking that data and modeling it perfectly, so that it's not just a matter of kind of getting all the data in one common place, but it's getting the details right. Like, what are the transactions that describe how investments have taken shape over time? And how do you use those transactions to understand the performance and the exposure and the risk of things? Those are the kind of the derived things, of course, that are the most important and give you a lens into, okay, I might own Apple in my portfolio in 17 different ways. One of those ways is owning Apple directly. The other 16 are owning it through some ETF that I bought or some fund that invested in Apple. And so being able to unpack all of those details and look through different things that have historically just been seen as a line item, just like, hey, this fund, wouldn't it be nice if you could actually understand kind of the in technical terms, sort of the leaf node of each thing in your portfolio. Do the complex math on top of these transactions so that you understand, again, performance reporting, the risk statements. You can group these calculations, so understand at a glance how exposed am I to Ukrainian debt? How exposed am I when the Swiss central bank decides overnight to make a policy change and it moves a massive amount? How exposed am I when crude moves almost 50% over the course of 6 months? These are things that happen all the time. And in moments of crisis, if you don't have the ability to, again, just at your fingertips know what you have, how exposed you are, you're habitually going to make bad decisions, or suboptimal decisions, should I say. And so making it super fast. This part is just making it so people who own these investments can run analysis and then change their minds and tweak their analysis and ask a different question. Making it really fast so that you can iterate on these questions in an interactive way. This fundamentally changes the way that people think about their portfolios, because now you can go through so many different scenarios. You can anticipate what might happen in the world and kind of look at your portfolio in different ways and through different lenses. Now, so those first four parts I kind of categorize in the data aggregation, kind of pulling everything together problem. The reality is many of the people who are managing these portfolios aren't technical. They're experts at investments, but they're not technical people. So displaying this data really intuitively, presenting it at the right layers, where you want to give, if you can only show who follows Tufte. Yes. Okay. So if you have one layer of information that you want to show, what's the best layer that you can show, and how can you give people the opportunity to double click on a different part of that portfolio and unpack that and kind of progressively disclose new parts. So getting the intuitive display of information and getting that user experience just right makes it so this type of solution is one that can add value to a ton of people who, again, cover this $120 trillion world. One of the problems, finance has been trying to adopt open standards for a long time, whether it's the way that data is formatted, whether it's identifiers to uniquely identify different securities, and there are conflicting standards, and there are half-hearted attempts to really adopt those standards. One of the things that we really learned at Palantir is you need to get really good at integrating data from a whole bunch of different places where the data, you just need to accept the fact that data is going to be in different forms. And you need to get good at integrating it and then unifying it. Once you have it unified, you kind of back into an open standard. So aspirationally, what we want to do is just have Addepar's platform over time serve as more of a utility for people who want to bring to bear new financial products, new financial tech, and make use of a common data set that describes what's in the portfolio in a way where you can kind of sidestep this aggregation, reconciliation, translation problem that I think consumes more than half of the bandwidth that people in fintech are struggling with. And of course, this is an unbelievably coveted data set, and so securing everything. Again, in my previous life, we dealt in a lot of pretty secure environments, and so this is something where cybersecurity, as everyone knows, is a very real problem. It's a problem that affects everybody every day. And so being really proactive in designing, recognizing that this is a weakest link problem, and what can we do to ensure security standards across this data set and for anyone who's interacting with it. So that's a lot of problems. And that's really why we're 70+% on the R&D side at Adapar. We're always going to be that way. This is really just a remarkable problem space that breaks down into a bunch of super interesting technology problems and design problems, and really take the investor mindset to understand which of those problems are most important and how they really weave together. And so, we always talk internally about our culture of innovation. That's really what powers us. We see such a radical opportunity here, where we see this basically greenfield opportunity in this $120 trillion world to just rethink the foundation. There isn't a foundation right now. If the foundation is people and spreadsheets, obviously we can do a lot better than that. And if we come up with a common foundation, that's something that I think will serve each and every investor. We'll just make markets behave better, give people the opportunity to make data-driven decisions. And so our vision is really just for a modern world of finance that's built on integrity, transparency, and impact. Really, really think hard about that. Would you describe the current world of finance as having these core values? I don't. I think certain people try to live by these values. And for the people who do try to live by those values, oftentimes they're encumbered by their current tech. So we want to empower those people with new tech to actually live by those values and be able to uphold them day in and day out. And for the people who fundamentally just are at odds with those values, I think that shining a big bright light on the industry and getting people, kind of showing people what's possible with technology so that you can have the opportunity to uphold these values, I think is fundamentally a good thing for the world. And so really our mission as a company is to build the technology to make this a reality, have the right clients on board, and really push hard. So really what we're doing is we're racing to build this platform. Imagine where, I'm not saying investors are going to be right all the time. Of course, investors are going to be wrong. But capital markets exist in such a way where we can each have a different point of view on what's going to happen. What I do think ought to be the case is investors can at least make data-driven decisions. They can know with conviction what they're doing, why they're doing that thing, and that they have the right information at their disposal to understand what the potential risk could be. I think once you get that foundational problem right, we can really encourage competition for next generation financial services and investment products and stuff like that, where these investors can judge the merits of each of those offerings based on data, based on results, based on impact. And that's something where I think this, the way that you bring trust and common sense back into markets is if you can, again, just shine this big bright light on the space that's just been, so discombobulated for such a long time. And what I encourage our clients and our partners and audiences like this to do regularly is just use common sense. Like fight inertia. There's so much inertia in this part of the market. And we now have the tech. We now have the tools to actually push on that inertia and rethink, what should this look like? So that's why it's so exciting for me to be here today and really to be with this audience and hear what you guys are thinking about. So with that, I'd love to open it up to questions.
When you look at different asset classes and different types of data, so much data is structured in different ways. How do you go about getting that data structured the right way and in a way that you can make use of it?
Yep. That's this problem. So let's take a couple different examples. Our average client has accounts at 5 different custodial banks. They may hold the exact same bond at JP Morgan, at Goldman, at Fidelity, at Schwab, at TD. The way that each of those banks is keeping track of the information on this bond, maybe it's a foreign bond, the way that they represent that in digital format could be different, because again, we don't have data standards. So each of those 5 banks is going to send that data to Addepar each night with a unique layout of data. We build feed handlers for each of those where we recognize the underlying what we call transaction effects that have to do with that particular type of asset. And we map that to our internally consistent, what we call our global financial format. So we make it so the person who owns those assets doesn't need to think anymore about the fact that they have this bond across 5 different banks, because we're taking care of that heavy lifting. We're integrating it in the 5 different ways, 5 distinct ways. We're unifying it into a common data model so that they can just interact with that as their bond position that happens to be spread across 5 banks. Or if they want to, they can break that down into, I know that I have 5, this bond across 5 accounts, so if a custodial bank has a problem, they can deal with that. So long story short, for each source, we have to write a processor for that source. We've gotten really, really good at building new feeds. Once you look at, at the end of the day, there are only so many asset types out there, and you can only describe them in so many different ways. But it all really breaks down into, dual entry accounting. So how do you map, how does this actually hit your balance sheet? And how does that change over time? And so because we've been able to define that in a unified way, it just becomes a mapping exercise for each of the underlying sources.
Building on that point, Building on this point, how long does it take to onboard new clients?
It depends on a few different things. In terms of, because we have this natural economy of scale, where once we built a feed to a custodial bank once we have the second client come in and have accounts at that same bank, then it's just a matter of configuration. Some of the things we can't control, basically the non-technical things are the parts that take the longest amount of time in an onboarding. So telling those custodians you need to turn on the feed for these 5 accounts, doing that across 5 custodians, that's the part that we can't really control. We're actually doing things about that as well, building strong relationships with those types of partners where they have a vested interest also in serving their clients. It turns out the custodial business is getting quite competitive as it becomes increasingly commoditized. So finding ways, again, from a non-technical but more business standpoint, to better align ourselves with partners and build out this ecosystem that really serves our mutual clients. That's how we can really pull in the timeline. We had a deployment last week that we had a client up and running within a week. This is something where deployments, this client said that they accomplished more in 2 weeks on Adapar than they did in 4 years on their prior systems. And so that's something where the group who co-led our Series C last year, they've invested in everything that Elon Musk has built. And when I spoke with Elon about their track record and the various portfolio companies that this particular investor had helped, he was explaining how some of the non-technical problems at companies like Tesla and Solar City really come down to operational efficiency of processes internally. And so this particular investor of ours has also been on site at Adapar for the last 9 months, really just streamlining that deployment process, because we want to take the risk out of it for our clients. We want to give them confidence that, yes, once you've seen a sexy and compelling demo, you can make it your own. You can really get behind the wheel and get value out of it really quickly and without risk. Other questions?
Go ahead. What do you think about other platforms like your platform compared to things like Aladdin or like big things? I mean, not exactly the same thing, but like Bloomberg. Do you interact with those? How do you see them? Do you see them as competitors or partners? Or
Sure.
What do you think about other like large software companies in the space?
Yeah, it's a great question. So Aladdin and Bloomberg are very different from one another. I think Aladdin, if you think about how foundational that was in making BlackRock what it is today, that's a system that's been around 10, 15, or I guess 15, 20 years at this point. But when Larry Fink describes it, it's just been so foundational in building out their business. Many of their clients are the largest institutions. Many of our clients today, like we're looking at this SMB market, if you will, as a really rich opportunity where if we can solve this problem for thousands of RIAs and for a whole bunch of family offices, and we can use the exact same solution at this endowment and that foundation and this pension and that sovereign, that's solving the problem, not just in integrating and aggregating the data, which Aladdin has done for certain categories of assets, but not for things like alternatives, but it's solving the problem in a way that's relevant to a much, much broader audience. So I think Aladdin, the most recent I saw, they had about $4 trillion of their own assets, of BlackRock's assets, and about $14 trillion in aggregate on Aladdin. That's something where I really I think that they're a great example of someone who had bucked the trend. They saw an opportunity. They built tech so that they can make better use of their people and tools, and they built a remarkable business on top of that. That said, I think just by virtue of having it be 15, 20 years old at this point, there are certain things that we're able to do that they can't quite do at this point. I don't see us as really competing with Aladdin at this point. We're going after a pretty different part of the market right now. I think we can actually learn a lot from each other, and so that's something I think there's a lot of mutual respect for our businesses. On Bloomberg, it's we're also not trying to compete with Bloomberg, which is kind of interesting. A lot of what they've been doing is pulling together publicly available data and making it really useful. One of the inspirations I had for leaving Lehman and joining Palantir back in 2006 was after I read Bloomberg's biography and really understanding his experience within Salomon Brothers. He was trying to build modern tech there. It just kind of didn't work. It was misaligned with the firm's strategy. And then it really took him getting kicked out the door and spending a weekend scratching his head and saying, shouldn't we have a convenient way to price bonds that doesn't involve pencil and paper? And really that's how Bloomberg was born. And so I think, again, the nature of the problem that we're solving starts with understanding the private information that describes one's portfolio. That's a problem that Aladdin's solving that Bloomberg kind of hasn't really tried to do that in earnest. And so anyway, I think we're in a pretty different space from either of those guys. I do truly believe that the thing we're mainly competing with are people with spreadsheets, where we want those people to be more efficient, more effective in adding value to their business.
Go ahead.
I just wanted to start with a quote from a friend who used to work at Microsoft. He said that, no disrespect, it's just funny. He said, Lehman Brothers tells us they make more money with Excel than we've made selling Excel.
Might be true. I'm not sure. I'm trying to run the numbers. No, I think that's the fact that Excel is the most pervasive financial tech on the planet, amazing for Microsoft, no doubt. The point I'm making is, if you look at the London Whale case, for example, where JPM lost several $1 billion on a trade because someone messed up a formula in Excel. It's stuff like that happens all the time. That happened to be a case where someone shined a big bright light on it, and people can understand the consequences of that. My point is more, if your infrastructure is literally hundreds of thousands of spreadsheets, as it is with some of the largest asset owners in the world, you're subjecting yourself to an extraordinary amount of risk. Your infrastructure is a house of cards, and if there's a little tiny formula that's incorrect or whatnot, that just, you're setting yourself up for seriously bad news. Excel has gotten the traction and the penetration they have because it is sufficiently flexible to deal with a lot of the nuances that, the financial services has. It just doesn't afford a systematic solution to a lot of these problems that now need a systematic solution. So a lot of the regulatory changes that came out of Dodd-Frank are basically pushing on banks to say you need systematic solutions to these problems. You can't just throw people at it over and over again. You need it to be non-deterministic, or you need it to be deterministic, not non-deterministic, and you need it to be fast.
If I just had to ask a question, in addition to my quote,
I love the quote.
just remind me of it. But how would you
Could you compare the analytics that is or will be available in Addepar with the analytics that as currently exists in Bloomberg, or is it very apples and oranges?
I'm sure there's certainly some overlap, some foundational things like computing returns. I think again our data domain is pretty different from Bloomberg's data domain. A lot of people are using us first and foremost for performance reporting on portfolios that are multi-asset class and multi-custodial. That isn't a problem that Bloomberg solves. And so the most commonly used metrics within Addepar are things that I think don't really interact with the surface area of Bloomberg necessarily. Bloomberg has a zillion different screens to do all sorts of really fancy stuff with structured products and trading and so forth. And those are things that are completely orthogonal to the problems that we're solving. I think over time there's of course overlap. We're building a platform, as I said, in a way that can be open. So just by capturing all the transactions and holdings and tax lots and so forth, and making that data available in a unified way, we're making it so either we or third parties can eventually, and this isn't kind of what Adapar is doing today, but eventually, build next-gen risk systems or tie into whatever they want or do market surveillance or whatever. Those are things that you can build those capabilities on top of the data set that we're capturing. And over time, we'll build some of that, and other people will build some of that. And those are the types of things where, if there's some merit to those types of analytics, I'm sure they'll exist in our broader ecosystem eventually.
All right, we have time for one more quick question.
So you mentioned that product is your number one focus, and you spend 70% of your expenses on R&D. So my understanding is that you rely very little on marketing and sales and rely mostly on word of mouth. So can you talk about how that strategy has worked for you so far and going forward?
Yeah, I think we're able to run in a pretty nimble way on marketing and sales. We do have marketing and sales, where at Palantir we didn't have a traditional sales approach. Part of why we do have a traditional sales team is because we're going at, we want to serve this SMB market that I'm describing. I'm really excited about the independent investment advisory space. I think the next generation, all these teams who are breaking out of large banks and who really aspire to have a higher quality of service that they can provide to their clients, I like helping those people build stronger businesses. So we want to make sure that we can reach them and that they're understanding that we're in the market and that they understand what we do. So that's why we have a marketing and sales team in the first place. That said, we have a lot of very natural channels that are available to us. So partnering with custodial banks, partnering with data providers, partnering with fund admins, partnering with other tech providers who have complementary offerings. So using those channels to get our tech into the right places is kind of more foundational to our strategy. So long story short, we can just be a lot more nimble on the business side of things. And also because 100% of our clients use the exact same version of the software, and everything's, the back end's all cloud-based and the front end's all browser-based, but we built it in a way that's highly configurable. From our client standpoint, it feels like we've done all the development in a custom way for them. From our standpoint, we're able to run in a really efficient way. We're rolling out new versions twice a week. And so the tech the tech strategy comes before the business strategy and allows us to run a much more nimble business.
All right, thank you very much.
Cool. Thank you.